Hi, in this video we're going to talk about how to draw a payoff diagram. A payoff diagram is a way to visualize an option trading strategy. Or when you're using derivatives and you want to see, am I making money when I have a call option and I have a put option, and I want to see if the stock goes up or goes down, am I actually making money from my strategy? If you haven't seen my videos on short call options or long put options, you may want to check those out. That might be helpful. Otherwise, let's dive into it. This here is a payoff diagram. You have your stock price on your x-axis, and you have your profit, the amount of money you make, on your y-axis. And you can see here that the scale is a little bit unusual, but that's fine. It's just a way to visualize whether you're making money or not. So the values I'm going to be using here are stock price $120, the price to purchase the call option of $1. The exercise price of the call option is $122, the price of the put option is $1, and the exercise price of the put option is $118. The place that I like to start is always at the beginning stock price. So today's price of the stock is $120. And what's going to happen from now into the future? Well, if the stock price goes up, let's just focus on our three different strategies that we're using here. We have a long stock strategy, so we purchase the stock. We have a short call strategy where we wrote a call strategy on the stock, the same stock, and we also have a long put strategy on the stock. So as I was saying, we start off, if we're using a long stock strategy, at 120, today's price, and if the price of the stock goes up to, let's say, $122, then you're going to be making more money. Let's say the stock price is $121. Well, you just made $1 profit. If the stock price went to 121, the stock price went to 122, then you made $2. So that should be pretty straightforward. This is just straightforward long stock strategy. Next, let's go into the long put strategy. Let's change colors. So where do you begin here? You need to recognize what is the strategy in first place on its own. Is it long? Is it short? Well, in this case, it's a long, and it's a put. Okay, so if you remember, a put is where we have the right to sell the stock. And we have the right to sell the stock at $118. So at this value here, this is anything here and lower, we actually make more money. So let's draw that out. And the amount of money that we can make is, well, a stock price could go to zero and you can still sell at $118, which means you'd have a profit of $118 minus the price you paid for the put, which is $1. So that's 117. That's the maximum amount of money we could possibly make. And the if, let's say, the stock price went to $118, then you wouldn't exercise the put option anymore. So at this point, you'd actually be making no money, and you'd actually be losing money at $118 because you wouldn't make any money and you wouldn't exercise it. So I'm going to draw a line down. Just make that clear. Okay, so just to refresh, the amount of money you could possibly make is $118 minus the price you paid for the long put, so that's 117. And at 118, you're no longer going to exercise. Well, I guess you could exercise, but you wouldn't make any money out of this. So then at that point, you'd just be negative $1. Yeah, that's it for the long put. Next up, let's do the shorts call. So a short call, remember, a call strategy is the right to buy. And since we're short it, that means someone else has the right to buy from us. If someone else is buying from us, that means we would have to have something to sell, which means we would have to buy it from the market. the price that we make in the beginning, since we wrote the call, is $1. So we're going to start at $1. And at $122, at that point, we're no longer going to be making any money. Because, we're going to be losing money because they're going to exercise, and we're going to be not going to be making money of that. So we start at 1, and since it's not going to be exercised until it gets to 122, at which point it gets exercised, and we start to lose profit. Okay, so we've drawn the short call, we've drawn the long put. Now, looking at this, we can actually figure out what is the overall strategy. So, remember we start at the initial price, which is $120, because that's our original price. And now we just have to look at the slopes of everything else. So, this has a slope of 0, this is a slope of 0, this is a slope of 1. And you're just going to be summing the slopes together. Now, how do I know this has a slope of 1? Well, if the stock price goes up $1, let's just look at the long stock on its own. The stock price goes up from 120 to 121. That means we made $1. So that's a slope of 1, right? And you can use that same thinking for this slope and for this slope. So back to this. Since we're going to be summing the slopes up, and here this is slope of 0, this is slope of 0, and this is a slope of 1. So all this area is just going to be starting at 120 and moving up a slope of 1 and moving down the slope of 1. So we can draw that. A bit messy, but whatever. Okay, now why did I stop here? Well, I can see that there's a difference in the slopes here. Now this here is a slope of 0, this is a slope of 1, and this is a slope of -1. So -1 and 1, well, that cancels out, right? So we now have a slope of 0. So from here onwards, it's a slope of 0. And I already knew this was going to be -2, so I wrote this here. But you wouldn't know that in the beginning, so you just have to figure that out. So looking here, we can see that from $118 all the way to 0, our profit is actually -$2, all the way from 118 to 0 in the stock price. Now let's look at the other side. So from here we have a slope of 0, we have a slope of -1, and we have a slope of 1. So that cancels out as well, and we have a slope overall of 0 again. So I can draw that. So here we can see that, once again, we can see that the profit is 2 now, plus 2. So from anywhere $122 stock price onwards, we will be making $2 from this strategy. Anywhere from $118 and less, we'll be making -$2, and anywhere in between, we'll be making from -2 to $2. And if the stock price stays at $120, interestingly, we can see we actually don't make anything. We just come out even, assuming there's no transaction costs. Unlikely, but. So, this is our payoff diagram, and this happens to be a caller strategy, which is why I drew this up here. There's a bunch of these different names, caller strategies, and there's a whole bunch of different names that they use depending on how this looks. But overall, you would want to draw this out to figure out what is the individual strategy on its own. Then you start out with the initial price today, which in our case is 120, and then you look at the slopes to move up, to move down, and the slopes will just cancel out, and you'll be ending up with your nice payoff strategy. A few things to note that I thought were a little bit tricky when I was beginning was to know where is this at the top, because it's not to scale, right? So it's a little bit tricky to remember that. You just have to realize, well, if you're using a short strategy, the amount of money that you can make is from the exercise price to the bottom, $118. And it would be the same for here if you had some kind of call option. It goes up to infinity, right? On the other end. So I think that's everything for payoff diagrams. Hopefully that was helpful. And we'll see you next time.